My name is Mike Hermsen, and I'm a corporate and securities partner at Mayer Brown in Chicago. I'd like to welcome everyone to our webinar titled Preparing for the 2017 U.S. Proxy and Annual Reporting Season. I am joined by three of my colleagues, Harry Boudry, Jen Carlson, and Laura Richmond. Harry is a highly experienced corporate and securities partner in our Houston office. Harry represents clients in a wide range of capital markets transactions, as well as both public and private company mergers and acquisitions. He routinely advises clients regarding compliance with securities laws and stock exchange rules, corporate governance, and other matters. Jen is a corporate and securities partner in Mayer Brown's Palo Alto office. Her practice focuses on capital markets, mergers and acquisitions, and general corporate matters. She also counsels companies regarding securities law compliance, stock exchange listing requirements, fiduciary duties, corporate governance, and other matters. Laura's wide-ranging corporate and securities practice has a strong focus on corporate governance issues and Securities and Exchange Commission reporting obligations, including proxy statements and related executive compensation disclosure matters, annual reports, boards of directors, and Dodd-Frank and Sarbanes-Oxley compliance. During the webinar, you will be provided with an alphanumeric code. Participants who are applying for CLE credit must record this code on the virtual sign-in sheet that was emailed with the connection details. Directions for returning this document are on the sheet. This code will be read in the middle of the presentation and then again at the end. Please note that in order for Mayer Brown to provide you with CLE accreditation, you must record this alphanumeric code and return it to Mayer Brown with a sign-in sheet. I'm going to get us started by talking about the 4 SEC compensation-related rules that were mandated by the Dodd-Frank Act. I want to begin with the compensation-related rule that has been adopted by the SEC, pay ratio. The initial pay ratio disclosures will be required for a company's first full fiscal year that begins on or after January 1st, 2017. Therefore, companies generally will first be required to include pay ratio disclosure in their 2018 proxy statements. Pay ratio disclosure will have to be included in all filings that require executive compensation disclosure, such as annual meeting proxy statements. Some companies are exempt from having to comply with the pay ratio disclosure requirements, including emerging growth companies, smaller reporting companies, foreign private issuers, Canadian companies subject to MJDS, and registered investment companies. Briefly, pay ratio disclosure will require public companies to disclose the median of the annual total compensation of all employees other than the CEO, the annual total compensation of the CEO, and the ratio of these amounts. If a company chooses to express the ratio numerically, it needs to do so in relation to 1, as in 50 to 1. Alternatively, a company may express the pay ratio narratively, as in the total annual compensation of the CEO is 50 times that of the median of annual total compensation of all other employees. In addition, the rule requires a brief non-technical overview of the methodology used to identify the median employee and any material assumptions, adjustments, or estimates used to identify the median employee or to determine total compensation or elements of total compensation. For purposes of the pay ratio disclosure rule, the term employee means an individual employed by the company or its consolidated subsidiaries, including full-time employees, whether based in the U.S. or outside the U.S., part-time employees, temporary employees, and seasonal employees. However, a worker employed by and whose compensation is determined by an unaffiliated third party, such as independent contractors or leased workers, are not considered employees for purposes of the pay ratio disclosure rule. The determination of the median employee can be made as of any date determined by the company within the last 3 months of the company's last completed fiscal year. So a company does have some flexibility in trying to decide when they need to calculate who their median employee is. There are 2 limited exceptions from the definition of employee. for certain non-U.S. employees. The final rule provides an exemption for employees in a foreign jurisdiction if compliance with the pay ratio disclosure rule would violate that jurisdiction's data privacy laws or regulations. If a company relies on this privacy exception, it must exclude all employees from that jurisdiction from its pay ratio calculation. The SEC also provided a de minimis exception for non-U.S. employees. A company may exclude up to 5% of its non-U.S. employees from its pay ratio calculation. However, if the company excludes any employees in a particular non-U.S. jurisdiction, it must exclude all employees in that jurisdiction. In addition, employees excluded pursuant to the privacy exemption I just mentioned will count toward the 5% limit for the de minimis exemption. The pay ratio disclosure rule gives companies flexibility to select a method for identifying the median employee that is appropriate to the size and structure of their businesses and compensation programs. Companies may determine the median employee based on any consistently used compensation measure, such as compensation amounts reported in its tax and/or payroll records, total compensation regarding their full employee population, statistical sampling, or any other reasonable method. The rule permits companies to identify the median employee only once every 3 years, as long as there has been no change in employee population or employee compensation arrangements that would significantly change the pay ratio disclosure. Once the median employee has been identified, the total compensation for the median employee will have to be calculated consistent with the requirements for calculating the CEO's total compensation for purposes of the summary compensation table. In determining the median employee and calculating his or her compensation, a company is permitted to use a cost of living adjustment for employees living in jurisdictions other than the jurisdiction in which the CEO resides. But if a company does this, it will have to present the employee's information with and without the cost of living adjustment. Pay ratio disclosure is not going to be required to be included in the prospectus for an IPO. It's only required in connection with the first year following the year in which a company becomes a reporting company. Also, individuals who become employees as a result of a business combination or the acquisition of a business can be omitted from the company's identification of the median employee for the fiscal year in which the transaction became effective. The pay ratio disclosures will be filed and not furnished disclosures. Therefore, they will be subject to the certifications by the CEO and the CFO, which are done quarterly, and subject to potential securities law liabilities, such as the anti-fraud rules. Although pay ratio is not required for 2017 proxy statements, companies should be preparing for compliance with the rule. Companies should be determining the methodology they will use to select the median employee and calculate and report their pay ratio disclosure, and if necessary, coordinating their reporting systems in various jurisdictions. Companies should be developing adequate disclosure controls and procedures to ensure compliance and determine whether there might be any internal morale issues this disclosure could create. Finally, last week the SEC issued some interpretations on how to apply certain provisions of the new rule, and it is reasonable to expect that additional interpretations will come out before the first disclosures are required. So stay tuned. I am sure that there is more to come. Now I want to turn and talk about the clawback proposal. The rule was proposed in July of 2015, but has not yet been adopted. The SEC proposed new Rule 10D-1 that would direct the national securities exchanges to establish listing standards that prohibit the listing of any security of a company that does not adopt and implement a written policy requiring the recovery or clawback of certain incentive-based compensation. The application of the rule would turn largely on the definition of two terms, incentive-based compensation and financial reporting measure. Incentive-based compensation would be defined to mean any compensation that is granted, earned, or vested based wholly or in part on the attainment of any financial reporting measure. A financial reporting measure would be defined to mean a measure that is determined and presented in accordance with accounting principles used in preparing the company's financial statements. Any measure derived wholly or in part from such financial statements, including non-GAAP financial measures, stock price, or total shareholder return. Any recovery under a mandated clawback policy would be based on the amount of incentive compensation that is later shown to have been paid in error. So in essence, it becomes that amount the person received versus the amount that that person should have received. There are two special situations: awards based on stock price or total shareholder return, and awards from a bonus pool where it might not be easy to calculate the amount to be repaid. Because incentive-based compensation that is based on stock price or total shareholder return is not subject to mathematical recalculation directly from the information in an accounting restatement, companies would be permitted to determine the recoverable amount based on a reasonable estimate of the effect of the accounting restatement on stock price or total shareholder return. If a cash award is paid from a bonus pool, the size of the aggregate pool would be reduced based on applying the restated financial reporting measure, and no recovery would be required in cases where the aggregate pool would have been sufficient to cover individual bonuses. There are a few highlights of the proposal that I also want to, a few other highlights of the proposal that I want to mention. The callback provisions must apply to any individual who served as an executive officer at any time during the performance period in question. The clawback provision is no fault, so the provisions apply whether or not a person engaged in misconduct or was responsible for the erroneous financial statements. A company would be required to recover any incentive-based compensation paid during the 3 fiscal years preceding the date on which the company is required to prepare the restatement to correct a material error. Clawback policies would be required to be filed as an exhibit to a Form 10-K. A company must include disclosure in its proxy statement if it prepared an accounting restatement that required a clawback and it had an outstanding balance of unrecovered excess incentive-based compensation. The information to be disclosed includes the names of each person subject to a clawback and any amounts that have been outstanding for at least 180 days. Recoveries are to be based on pre-tax amounts, which could cause problems for recipients, such as if they had settled in an equity award on a net share basis or had had shares withheld for taxes. They may wind up paying more back to the company than they actually received on settlement. A company would not have to seek recovery if the direct expense of recouping compensation would exceed the amount recoverable. In connection with pool plan recoveries, recovery from all covered executive officers would be required to be pro rata. A decision could not be made to recover more from one executive officer on a percentage basis than from any other executive officer. A company would be prohibited from indemnifying their executive officers for amounts recoverable pursuant to clawback policies or paying premiums on insurance policies protecting against such recoveries. These proxy statement disclosures would have to be block tagged using XBRL, and summary compensation table amounts would be restated to reflect the impact of any clawbacks. Even though the rule is not yet effective, there are a couple of things companies should be thinking about now. Companies with existing clawback policies should be thinking about what changes, if any, will need to be made to those policies. Companies without existing clawback policies should be thinking about what aspects of their compensation will be subject to the recovery provisions, how they plan to implement the policy, and when they should implement the policy. Companies should also be thinking about how they will implement any policy under other laws, such as applicable state laws, particularly with respect to previously earned compensation or with regard to persons who are no longer employed by the issuer. I now want to talk a little bit about the pay for performance proposal. This rule was proposed in April of 2015, and again, it has also not been adopted. The SEC has proposed adding new subsection V to item 402 of Regulation SK, requiring companies to disclose in a clear manner the relationship between executive compensation actually paid and the financial performance of the company. There are two aspects to this proposal. The first is a chart, which is up on the screen, that would appear in proxy statements. It looks very similar to the summary compensation table. The chart is to include separate line items for the compensation of each principal executive officer individually and the average compensation of the other named executive officers for each year. If there was more than one principal executive officer during the year, all compensation for such persons would be aggregated for that year. With two exceptions, the numbers in the pay for performance table would be calculated the same as they are now for the summary compensation table. The two changes are that the aggregate change in actuarial present value of the accumulated benefit included in the summary compensation table would be deducted, and the actuarially determined service costs for services rendered during the year by the executive would be added. And the other change, equity awards granted during the year would be deducted, and equity awards vested during the year would be added, based on their fair market value on the date of vesting. In addition to the table, companies will also need to include a clear description of the relationship between pay and performance in narrative or graphic form, or a combination of the two. As with the clawback disclosure rule, these proxy statement disclosures would have to be block tagged using XBRL. The disclosures would be phased in over a 3-year period, with 3 years of disclosure in year 1, 4 years in year 2, and 5 years in years 3 and thereafter. One thing that a company should be thinking about now is the relationship between this disclosure and the other disclosures that it provides, such as in CD&A, particularly if it says that a company pays for performance. Will the numbers that wind up getting disclosed in response to this requirement back that up? And if not, companies should be thinking about how that might impact their CD&A disclosure. And finally, I want to talk briefly about hedging disclosure proposal. This rule was proposed in February of 2015 and is the third proposal that hasn't yet been adopted by the SEC. The SEC has proposed adding new subsection I to item 407 of Regulation SK, requiring companies to disclose in their proxy statements whether their employees or directors are permitted to engage in transactions to hedge or offset any decrease in the market value of their company's equity securities granted to them as compensation or held directly or indirectly by employees or directors. The rule proposal covers all transactions that establish downside price protection in a company's equity securities, whether by purchasing or selling a security or derivative security or otherwise. The resulting disclosure would need to make clear which categories of price protection transactions a company permits and which it prohibits. The proposed hedging disclosure rule would apply to all companies that are required to comply with the SEC's proxy rules, including smaller reporting companies, emerging growth companies, business development companies, and registered closed-end investment companies. The proposed rule does not require companies to adopt hedging policies. However, in light of the proposed rule, as well as corporate governance concerns that have been raised, companies may want to review their existing approaches to hedging to consider whether any new or amended policies would be appropriate and when they would be appropriate. The proposed hedging disclosure requirement would extend beyond the existing requirement in the CD&A, which requires disclosure of material information necessary to understand compensation and includes hedging policies, if material, as it relates to executive officer compensation. If a company is considering revising an existing hedging policy or adopting a new hedging policy, one thing to think about is whether the policy should apply to all employees and directors equally, or whether different policies are appropriate for different categories of employees or different categories of hedging activities. And with that, let me turn the program over to Laura.
Thanks, Mike. I'll be talking about Say on Pay and its impact on proxy statement disclosure and design, as well as shareholder engagement. In 2016, most Russell 3000 companies once again had passing Say on Pay proposals with average votes above 90%. There were only a small number of failed Say on Pay votes in 2016, and if you look at the 5-year history of Say on Pay, only 10% of these votes ever failed, although more than a quarter received less than 70% votes in favor at least once, and that's a level that ISS views as problematic. Companies worry about what ISS thinks because a negative ISS recommendation lowers support, but keep in mind it does not necessarily result in a failed say-on-pay vote. Although say-on-pay is an advisory vote, a positive outcome has become very important to senior management and directors of public companies. And as a result, executive compensation has become an integral part of shareholder engagement. Shareholder engagement on compensation has become a year-round process, and that's for a variety of reasons. Proxy season is a very busy time for institutional investors, so it's easier to meet with them during the off-season. Also, companies need to disclose in their CD&A how they took the prior say-on-pay vote into account, so they often want to discuss compensation with their investors after the vote to find out if there are any issues in particular that concern them. And shareholder engagement disclosure in the proxy statement is often viewed as a sign of good governance. So meetings throughout the year provide a basis for a more robust shareholder engagement disclosure. Companies should prepare for these type of investor meetings by determining the specific compensation issues they want to emphasize and deciding who from the company should make the presentation. And companies may also want to reach out to proxy advisory firms as well as investors. In these next two slides, I'll show you the effort, including graphic design, that often goes into shareholder engagement disclosure in the proxy statement. You'll be receiving a copy of the slide deck after the webinar, so you can look at any of the examples I'm showing you more closely later. In the years since say-on-pay became mandatory, there's been much more of a focus on the proxy statement as an advocacy document supporting approval of executive compensation rather than just a disclosure document. And this has led to a change in proxy statement presentations. So, for example, proxy summaries have become very common with information about directors, brief descriptions of the matters to be voted upon, and often company performance issues, often highlighting the link between pay and performance. And graphics, color, design, plain English, and hyperlinked table of contents are now common proxy statement features. Many companies also focus on the online version of the proxy statement, and I don't mean the EDGAR copy. I'm referring to the version of the proxy statement that they put on their own website or on the internet voting site. And this electronic copy, for example, may include user-friendly bookmarking that's accessible throughout the document. And some companies even file a courtesy PDF copy of the proxy statement with the SEC along with their traditional EDGAR copy, because design elements they work so hard on don't always show up as desired on EDGAR. We're also seeing some additional elements being voluntarily added to proxy statements, and these can include a letter signed by the full board of directors or a message from the lead director. A proxy statement can include an alphabetical index of frequently requested information in addition to a traditional table of contents. And sometimes you see the CD&A beginning with a full table of contents or an organizational description. We've also seen Q&A sections on various subjects coming from the chairman or the lead director. And some proxy statements include something like a key value statement or a statement about a specific goal, such as company-wide diversity encompassing business partners as well as employees. And with corporate governance taking on a greater role in public discourse, graphics have an increased presence in the governance sections of the proxy in addition to what has become common in compensation sections. And as you can see, we've given you the names of companies that have used features described on these two slides in case you want to look up examples. Compensation disclosure and analysis is a mandatory disclosure element, so it clearly must be prepared so that it is responsive to all the relevant SK requirements. But it has become much more than line item disclosure, as the portion of the proxy statement that explains the executive compensation program and discusses the rationale for decisions, the CD&A plays an important advocacy role for approval of the executive compensation program, even if this section does not overtly request a favorable say-on-pay vote. As this section has become longer, executive summaries or overviews have become popular to highlight the goals of the program and recent changes, and the CD&A typically emphasizes the link between pay and performance, and it often employs graphics to present compensation in an easy-to-understand manner. The CD&A must disclose the prior year vote, how it was taken into account. That is, unless the company wants to make the unpalatable disclosure that it was not taken into account at all. So this disclosure is needed even if say-on-pay passed with an overwhelming majority. And it's often contained in a discussion of shareholder engagement. When changes were made in response to the vote, the changes are emphasized. But even when no changes are made, now there often is a more expansive discussion of why the existing program is still deemed appropriate, as opposed to just a statement that no changes were made because the shareholders approved pay at the last meeting. The next few slides illustrate some of the proxy features I've mentioned, and I'm going to flip through them quickly. You'll be able to review them more thoroughly when you receive the slide deck. So proxy summaries vary in length and content, and they often feature performance measures, as you can see on this slide. And the proxy summary may contain a description of the compensation program, often in easy-to-read graphic format. With respect to CD&As, here's an example of a detailed table of contents just for that section. And this CD&A explains at the outset how it's organized into distinct sections. This CD&A overview contains an easy-to-read what we do and what we don't do chart. You sometimes see something like this in the proxy summary. ExxonMobil provides examples of various different types of additional compensation materials that can be provided to shareholders as long as they are first filed with the SEC, such as a glossy overview that they initially provide to investors, supplemental benchmarking disclosure that comes later as information becomes available, and audio webcast slides. And here are two slides from Exxon's glossy compensation overview to give you an idea of what I mean. And with respect to governance, you can see from this slide that graphics is used to illustrate important topics such as risk oversight, or on this slide, board compensation, tenure, and diversity issues. Note on this slide and the next slide how Coca-Cola has incorporated branding into its graphics. And graphics are now sometimes used to mark the beginning of sections discussing voting items, and that can be useful, especially now that proxy statements have become so lengthy. In these two examples, you'll see that the voting recommendation appears right at the beginning of the proposal, and there's a brief description of the proposal, in effect forming a proposal summary. If ISS or Glass Lewis issue a negative voting recommendation, the company doesn't need to respond, but it may. The key is the company must file any soliciting materials to rebut the recommendation with the SEC before using them. And additional materials can be in many forms, from proxy statement supplements, shareholder letters, or slide decks. Even materials underlining oral presentations must be filed, such as scripts or talking points. And sometimes companies file additional materials to publicize a reversal by ISS. Switching gears, just a few words on compensation lawsuits. Recently, outside director compensation has become an issue, with courts viewing awards as self-dealing and therefore applying an entire fairness standard of review as opposed to the business judgment rule. And to minimize this risk, companies may want to consider adding shareholder-approved annual limits or annual formula-based awards to current or new plans, and boards may want to document their review of comparable companies and decisions for director compensation in case entire fairness scrutiny is needed. For many companies, 2017 will be the year when they will once again need to conduct an advisory vote to ask shareholders how often the say-on-pay vote should be held. Shareholders must be asked if they want executive compensation to be voted upon every 1, 2, or 3 years. This say-when-on-pay vote must occur at least every 6 years, even if the company plans to continue holding its say-on-pay vote on an annual basis. So if this affects your company, remember to make it a separate agenda item in your proxy statement, include it as a voting item on your proxy card and notice, and include the company's decision as to say-on-pay frequency in the company's Form 8-K reporting voting results after the meeting, either initially or in an amendment to that 8-K. Note that the say-when-on-pay proposal itself does not require a preliminary proxy filing. So now I'll turn the program over to Harry.
Thank you, Laura. 2016 was another busy year for shareholder proposals seeking to implement proxy access. In fact, for the second year in a row, proxy access proposals were by far the most common governance proposal submitted by shareholders. Over 200 proxy access proposals were submitted in 2016, and this was a 71% increase compared to 2015. As we look back over the past couple of years, it's clear that proxy access initiatives are making significant inroads. Over 40% of the S&P 500 companies have now adopted proxy access bylaws, and while some of the specific details of these bylaw provisions vary from one company to the next, there appears to be an emerging consensus regarding what is market for the fundamental proxy access terms. Given the recent success of these shareholder proxy access initiatives, we expect continued pressure on public companies to adopt proxy access bylaws. Despite some clear trends, however, there remain areas of uncertainty which we will discuss. Next slide. The right of shareholders to nominate director candidates is rooted in state corporate law, although most state corporate law statutes say nothing about a shareholder's right to nominate directors. Historically, however, shareholders who wish to nominate directors had to do so at their own expense, bearing the cost of preparing, printing, and mailing their own proxy materials. Proxy access gives certain shareholders the ability to include their director candidate in the company's proxy statement, a much less expensive proposition since the company bears the cost of its own proxy materials. Next slide. As many of you are aware, in 2010, the SEC adopted a final proxy access rule, which would have made proxy access mandatory for public companies. But the SEC's proxy access rule was vacated by the D.C. Circuit Court in 2011 on the grounds that the SEC did not adequately address the economic impact of the new rule, which it is required to do. However, the SEC also amended the proxy rules to allow shareholders to propose company-specific proxy access mechanisms. Next slide. Initially, it was unclear whether and to what extent shareholders would pursue proxy access through the shareholder proposal process. If you look back at 2012, 2013, and 2014, only a few shareholder proposals supporting proxy access were submitted. All of that changed in the fall of 2014 when the Office of the New York City Comptroller, on behalf of several New York City pension funds, sent out 75 proxy access proposals to large public companies as a part of its boardroom accountability project. The Comptroller's Office targeted companies based on 3 priority issues: climate change, board diversity, and excessive executive pay. Next slide. The Comptroller's proxy access proposal is modeled after the vacated SEC rule and included many of the same features. The key terms are highlighted in this slide. It called for companies to adopt a bylaw amendment that would give a shareholder or group of shareholders who have owned 3% or more of a company's stock continuously for 3 or more years the right to include their director nominees representing up to 25% of the company's board in the company's proxy materials. The Comptroller's proposal did not put any limit on the number of shareholders who could form a group to satisfy the 3% ownership requirement. Next slide. Other activist shareholders submitted similar proxy access proposals, and in total, 116 proposals were submitted in 2015. Whole Foods Market, who had received a proxy access proposal earlier in 2014, sought to exclude the proposal under Rule 14A8 on the grounds that the shareholder proposal was in conflict with a proxy access proposal that management had approved and would submit to the shareholders for a vote. The proxy access proposal put forth by Whole Foods management had more stringent eligibility requirements. Specifically, the management proposal would have required ownership of at least 9% of Whole Foods stock for a period of 5 years. The SEC staff initially concurred with Whole Foods and granted no action relief, which would have allowed Whole Foods to exclude the shareholder proxy access proposal. Almost immediately, a number of other companies that had received proxy access proposals submitted letters to the SEC requesting similar no action relief, citing the Whole Foods no action letter. That letter turned out to be fool's gold. In January of 2015, the SEC issued a statement that it had withdrawn its no action letter to Whole Foods, that it would not express any view on the applicability of Rule 14A8I9 during the 2015 proxy season, and that it would review the scope and application of the rule going forward. As a consequence, over 90 of the proxy access proposals went to a shareholder vote in 2015, and 60% of those proposals passed. Proxy access proposals, on average, received 55% votes in favor in 2015. Next slide. Many of the companies that had defeated the proxy access proposal in 2015 were told that they could expect another proxy access proposal for the following proxy season. As they waited for the next proposal to come in, the SEC staff issued Staff Legal Bulletin number 14 in October 2015 and clarified its view of the scope and applicability of Rule 14A8I9. Not surprisingly, the SEC took a much narrower view of the rule than was suggested by the Whole Foods no action letter. The SEC advised that going forward, shareholder proposals are excludable on the grounds that they are in direct conflict with a management proposal if, and only if, a reasonable shareholder could not logically vote in favor of both proposals. Said another way, the proposals are not in conflict if there are distinctions between the two that are meaningful to shareholders. Of course, this raises the question as to whether a 5% versus a 3% ownership requirement is a meaningful distinction. And possibly anticipating this question, the SEC included an illustration of proxy access proposals that are not in direct conflict. A proposal requiring 3% ownership over 3 years to nominate candidates comprising of up to 20% of the board would not be in direct conflict with a management proposal requiring 5% ownership over 5 years for 10% of the board. As a result of this new interpretation, subsequent no action requests to exclude shareholder proxy access proposals have now shifted from the it directly conflicts with a management proposal argument to the proposal has been substantially implemented approach. Next slide. That brings us to 2016. Encouraged by the results of shareholder votes in 2015 and the SEC's narrower interpretation of what constitutes a directly conflicting proposal, the New York City Comptroller's Office submitted another round of proxy access proposals, as did other pension funds and activist shareholders. The number of shareholder proxy access proposals submitted to public companies increased by 71% compared to 2015, Fewer proxy access proposals, however, were put to a vote as a number of companies negotiated a withdrawal of the proposal or were able to exclude it on the grounds that they had already substantially implemented proxy access. Proxy access proposals requiring 3% ownership over 3 years were supported by a number of large institutional investors such as BlackRock, CalPERS, Goldman Sachs, and others. Vanguard, which had previously expressed support for a 5% ownership requirement, now supports a 3% ownership requirement. Proxy advisors also generally support a 3% 3-year formulation, but have said that they will review shareholder proxy access proposals on a case-by-case basis. Most significantly, over 200 public companies have now adopted proxy access bylaw provisions since October 2015. And to date, over 40% of the S&P 500 companies have instituted proxy access. Next slide. Looking at the bylaw provisions that have been adopted over the past year, there appears to be a consensus developing around the key terms of proxy access. With rare exception, proxy access provisions that have been adopted require 3% ownership over 3 years. Other typical terms include requiring shareholders to have full voting and economic ownership of their shares, sometimes called net long ownership, and limit the number of board nominees to 20 or 25% of the board, often with a minimum of 2 candidates. In addition, the number of shareholders that can aggregate ownership is often limited to 20, although provisions frequently allow funds under common management to count as just 1 shareholder. Next slide. We mentioned earlier that efforts to exclude shareholder proxy access proposals have shifted from the claim that the proposal conflicts with a management proposal to an argument that proxy access has been substantially implemented. Of course, companies that wish to make the substantial implementation argument must first adopt their own proxy access bylaw provision. This may be one of the reasons we saw so many companies adopt proxy access beginning last fall and continuing into 2016. Efforts to exclude proxy access proposals on grounds that they have been substantially implemented have received mixed results. Companies that received shareholder proposals calling for the initial adoption of proxy access bylaws have, with some exceptions, been generally successful in arguing that the proposal should be excluded because it has already implemented proxy access. On the other hand, companies that receive shareholder proposals to amend their existing proxy access bylaws have had more difficulty excluding those proposals to amend on the grounds that the proposal has been substantially implemented. And we saw this in H&R Block in July 2016. In this case, H&R Block had instituted a 3% 3-year proxy access bylaw, then received a shareholder proposal to amend its proxy access bylaws to remove the limit on the number of shareholders who can aggregate ownership and increase the number of director candidates that shareholders could nominate. After considering H&R Block's no action request, the SEC staff said that it could not concur that the proposal to amend had been substantially implemented. Next slide. And earlier this month, the SEC reached a similar conclusion with respect to Microsoft's request to exclude a shareholder proposal to amend its proxy access bylaw. Microsoft had also adopted a 3% 3-year proxy access bylaw, argued that its bylaw provision had achieved the shareholder proposal's essential purpose and that failure to grant no action relief would result in, quote, endless nitpicking over collateral aspects of bylaws and involve impossible line drawing. Apparently, the SEC was unpersuaded by this argument, as it was unable to concur that the proposal had been substantially implemented. And similar requests for no action relief have been submitted by a number of other companies, and we should see additional responses from the staff over the next few weeks. Next slide. So where does this leave us today? We expect the momentum behind proxy access to continue with another round of shareholder proposals targeting companies that either have not yet adopted proxy access or those that have implemented proxy access but on terms that aren't favored by the proxy access advocates. For those companies that have not yet adopted proxy access, a number of alternatives are available. One option is to go ahead and implement Proxy Access now, which might reduce the likelihood of receiving a Proxy Access proposal from a shareholder. However, as we've seen, some companies that proactively adopted Proxy Access have since received proposals to amend from shareholders and have been unable to exclude those proposals through the no-action process. Another option is to simply wait until a shareholder proposal is submitted, in which case a company could respond in any number of ways. For example, a company may negotiate with the shareholder proponent to implement a mutually acceptable proxy access provision and have the proposal withdrawn, or a company may adopt its own proxy access bylaw and seek no action relief on the grounds that it has substantially implemented the shareholder's proposal. This approach has been relatively successful in excluding a proposal to implement proxy access. Alternatively, a company may wish to put the shareholder proposal to a vote, either on its own merits or by proposing an alternate board-approved proxy access proposal. Given the recent levels of support among shareholders for proxy access, this approach is not without risk. The outcome will depend on a number of factors, most importantly understanding the inclinations and preferences of your company's shareholders. For those companies that have already adopted and implemented proxy access, they too may take a wait-and-see approach before amending their bylaws to conform their proxy access mechanism to market terms. If they receive a proposal to amend, there's no clear path to having that proposal excluded. However, if their existing proxy access bylaw is in line with the terms supported by the proxy advisors and institutional shareholders, it may be preferable to oppose the proposal to amend, clearly articulate reasons for opposing the proposal in the proxy statement, and put the shareholder proposal to a vote. One thing is clear, proxy access will continue to be an area to keep an eye on in 2017. Now I'd like to turn the program over to Jen Carlson.
Thanks, Harry. As Harry mentioned, the focus of shareholder proposals continues to be on corporate governance, and specifically due to the number of proxy access proposals. But on the next few slides, we've listed some other common corporate governance proposals. As we saw last year, proposals for an independent chair continue to decline, and proponents have also submitted fewer proposals for shareholder right to call a special meeting and proposals that advocate for shareholder action by written consent. Majority voting for director elections continues to receive proposals and strong support. Next slide. More proposals were submitted in 2016 to eliminate supermajority voting. Overall support remained approximately the same at about 60%. A new type of proposal emerged this year from a Canadian investment management firm. The proposal requested that a company's audit committee solicit proposals for outside auditors every 8 years. Although this is a new type of proposal, it is similar to other auditor proposals we have seen in prior years, including those requesting information about company policies on auditor rotation. All 15 proposals, however, were eliminated by no action letter, mainly for ordinary business operations. Along with the rise in companies holding virtual meetings, there's been corresponding criticism. Activists such as James McRitchie have spoken out against virtual meetings, criticizing companies for avoiding confrontations with shareholders and also offering templates that shareholders could use for future proposals. Companies that have moved exclusively to virtual meetings should look out for these proposals this season. Next slide. This year we saw a decrease in the number of proposals related to executive comp as compared to 2015. The decline could be the result of improved shareholder engagement, but also the result of the SEC's adoption of the pay ratio disclosure rule. Proposals regarding adoption or disclosure of clawback policies may also be down due to the SEC's proposed clawback rules, even though not yet adopted. Still, the most frequently submitted proposals have been limiting acceleration of vesting of equity awards and imposing stock holding periods for executives. In addition to the decrease in the number of proposals, the level of support has also decreased. Next slide. Environmental and social proposals continue to be the second most prevalent type of proposal after corporate governance, with nearly 300 proposals submitted in the 2016 season. There were more proposals on climate change than we've ever seen. Many proposals focus on how climate change will impact a company's operations and how companies plan to respond to governmental policies on climate change. In 2016, the number of proposals on diversity doubled as compared to 2015. The majority of the proposals related to a request for reports on diversity, either in the boardroom or at the employee level. And notably, one proposal related to gender pay equity at eBay received majority support, and a proposal on the adoption of a policy to enhance board diversity also received majority support at Joy Global. Next slide. We've listed a few other environmental and social proposals here. As in prior years, proposals on environmental issues generally received modest support, while social issues generally received low levels of support. Next slide. Since the Supreme Court's decision in Citizens United, we've seen many proposals related to political activity by corporations. More than half of the political activity proposals relate to lobbying, while another quarter were on election spending. New proposals in the past season included a revolving door issue between financial institutions and the government, where the proponent asked for company employees to forfeit accelerated vesting of equity awards if they leave the company to work for the government. But overall, there were fewer political activity proposals than we saw in 2014 and 2015. Although these proposals continue to have only moderate support, there were a few majority votes on oversight and disclosure of election spending. Next slide. I'll spend the next few minutes discussing a few other disclosure issues. In 2016, the SEC renewed its focus on non-GAAP financial measures. Some companies use these measures in their annual report and other SEC filings. Companies also sometimes use the measures to highlight performance measures in proxy statements to show the connection between pay and performance. Documents that are filed with the SEC must comply with Regulation G and with Item 10E of Regulation SK. In proxy statements, there are a few special rules for non-GAAP financial measures. When a company discloses target levels for incentive comp, the targets are non-GAAP measures, and the targets are non-GAAP measures. The disclosure is not subject to Regulation G, but the company must disclose how the numbers are calculated from the audited financial statements. All other non-GAAP measures used in proxy statements must comply with Reg G and Reg SK. There are a few instances where the SEC has provided that a company may show the reconciliation in a separate document. For pay-related disclosures in a proxy statement, a company may include the reconciliation to the most directly comparable GAAP measure in an annex to the proxy statement, as long as there is a prominent cross-reference to the information in the annex. For non-GAAP measures that are also included in the company's Form 10-K, the company must include the reconciliation in the 10-K, but does not also need to include the reconciliation in the proxy statement. The non-GAAP measure in the proxy statement may be accompanied by a prominent cross-reference to the specific pages in the 10-K. Next slide. As previously mentioned, the SEC has increased its focus on compliance with requirements for the use of non-GAAP financial measures. Recently, the SEC had begun issuing more comments to companies on their compliance, and in May of this year, the SEC issued new and updated compliance and disclosure interpretations. These CD&Is provide insight into what the staff considers to be misleading and what is considered unacceptable prominence of a non-GAAP measure in an SEC filing. Since the new CDIs were issued, the SEC has begun issuing more comment letters to companies that reference the new guidance. Companies should expect the SEC to focus on its non-GAAP financial measures when reviewing proxy statements, annual reports, and other documents filed with the SEC. Along with the increased attention in comment letters, please note that the SEC Division of Enforcement may also contact companies that have used or use non-GAAP financial measures in a way the SEC finds misleading. Recently, we have heard of the division contacting companies in these instances and asking for all copies and all drafts of such disclosures and related communications going back for a few years. The division has also asked these companies to self-report non-compliance with the non-GAAP rules. Therefore, you should not assume that the only penalty for non-compliance with the non-GAAP rules is an SEC comment letter. Companies need to continue reviewing their SEC filings and other communications for compliance with these regulations and the new and updated SEC guidance. It should be helpful for a company to review comment letters that have been issued to other companies and watch for any new comments from the SEC. Next slide. In recent years, we've also seen increased interest by regulators for enhanced audit committee disclosures to shareholders. In July of 2015, the SEC's concept release solicited comments on whether there should be greater disclosure by audit committees about their work. The release focused on 3 areas of disclosure listed here: oversight of the auditor, process for appointing or retaining the auditor, and committee consideration of qualifications of the audit firm. Although the comment period expired, the SEC has not yet released proposals but has encouraged voluntary disclosure. Amidst this background, we continue to see increasing amounts of voluntary disclosure by companies. A recent study by the Ernst & Young Center for Board Matters does a good job of describing some of these disclosures for Fortune 100 companies, including factors considered by the audit committee when reviewing qualifications, statements that the choice of auditor was in the best interest of the company, and explanations for increases in fees paid to the auditor compared to prior year. Next slide. These extracts from the GE proxy statement show several of these voluntary disclosures: an explicit statement that the audit committee is responsible for appointment, comp, and oversight of the auditor, the qualifications of the auditor that are considered, and a statement that the choice of auditor is in the best interest of the company and its shareholders. Next slide. Similar disclosures can be found in Coca-Cola's proxy statement. Next slide. And in Cardinal Health's proxy statement, including an explanation for the year-over-year increase in audit fees due to specific acquisition activity. Next slide. In accordance with the FAST Act, the SEC issued an interim final rule in June of this year, amending Form 10-K to allow but not require companies to include a summary of information required by that form. The optional summary must be presented fairly and accurately. Each item must have a hyperlink or cross-reference to the material summarized. It can only include information included in the 10-K when filed, but the summary does not need to be updated for information required by Part 3 of Form 10-K that is incorporated by reference from a later filed proxy or information statement. But the summary must state that it doesn't include such Part 3 information because it will be filed at a later date. There's no limit to the length of the summary, but it should be brief, and the rule doesn't specify what information should be included, but of course the summary must be presented fairly and accurately. Next slide. Finally, in connection with preparing your annual report, companies need to review their risk factors to ensure they adequately reflect current risks the company faces. In particular, companies need to focus on any new risk factors that may be needed, or perhaps existing risk factors that should be expanded to match the company's risk profile in the current environment. And we've listed here just a few examples to consider. But your financial reporting team, litigators, and others that monitor risk should be reviewing your risk factors and considering whether updates or changes should be made. And now I'll turn the program back to Laura. Laura?
Thank you, Jen. I'm going to conclude with just some remarks about annual meetings generally, a few matters. But first, I want to answer a question that was asked, and that is the say-when on pay vote can be conducted earlier than the 6 years. You don't have to wait for that full 6 years. You just have to conduct, the say-when on pay vote on frequency at least every 6 years. So if you want to do it early, that's fine. As for D&O questionnaires, there aren't any federal securities law changes requiring revisions to the questionnaire this year. If you use your questionnaire to identify persons for related person transaction reporting, you may want to check with your accountants to be sure they're comfortable that you have questions that satisfy their procedures for AS-18, which is the auditing standard for related parties that came into place last year. And if you're a NASDAQ company, you should consider whether you need questions about agreements between directors and any third parties relating to director compensation in response to NASDAQ's new golden leash disclosure requirement. Something you may want to consider this year is whether your company wants to conduct a virtual meeting, either as a hybrid, which allows both in-person and virtual attendance, or a completely virtual meeting. Both types of virtual meetings have been growing in number over the past few years. If you're interested in holding a virtual meeting, be sure to check the requirements of your governing law and your governing documents. For example, do you need a bylaw amendment or a formal board resolution? And I suggest you involve your board and nominating and governance committee in decisions you may be making as to virtual meeting, and also your investor relations department may have some views. And if this is your first time round, and even if it's not, I suggest you conduct dry runs to test the technology and have contingency plans in place just in case. For some breaking news, earlier today the SEC proposed universal proxy cards, and that would be mandatory if this gets adopted for contested director elections, requiring the proxy cards to include both registrant and insurgent nominees so that shareholders that vote by proxy could easily choose among the nominees as they would if they were voting at a meeting. And there's also some proposed related disclosure items. That proposing release should be available shortly. So if that's a topic you find of interest, you should be on the lookout for that and consider submitting comments to the SEC, because the SEC very much would like to have comments on this proposal. Finally, be aware that last March, the SEC provided a proxy card compliance and disclosure interpretation that clarifies how a proxy card must describe the specific actions on which shareholders will be asked to vote. So you should check to be sure your proxy card complies with this interpretation. The interpretation applies both to management and shareholder proposals. And as an example, if you get a shareholder proposal for a bylaw amendment to allow 10% holders to call a special meeting, the CD&I makes clear that it's not good enough to simply describe that proposal on the proxy card as a proposal on special meetings. So with that, our time for today is up. I want to thank Harry, Jen, and Mike for doing this call with me, and on behalf of Mayor Brown, thank you to everybody for participating in today's webinar.